Welcome back. At the half-year mark, Nedbank has posted a 2% rise in headline earnings per share and a 2% increase in headline earnings. This is thanks to an improvement in the impairment charge. The result was achieved in what the group calls a transformative year, where bold and swift strategic decisions were made. Most notable, the sale of ETI and plans to acquire a controlling stake in Kenyan bank NCBA in a deal worth nearly 14 billion rand. The company's CEO Jason Quinn joins us now with greater perspective on the performance and the group's plans moving forward. Hi Jason, good to chat to you once again. Right, 2%. 2% is the figure, but 8 million clients, the first time in 138 years. That's an achievement. What got you over the mark?
Well, firstly, good afternoon, Ray. Great to be with you and your viewers today. So yeah, I think the headline earnings, or let's say diluted headline earnings, up 2 or 3%, whichever way you look at it. Probably not our strongest performance as a print, but behind that, lots of activity. You mentioned some of that strategic activity. Disposing of ETI has financial consequences. In other words, we made accounting profit of that in the first half of just over 900 million rand, and of course that won't repeat. More importantly, though, we were able to safely dispose of that investment by the end of the year and receive the proceeds of $100 million unencumbered and with all regulatory approvals. And so, Ray, then once we've acquired NCBA by third quarter, we would have moved from, let's say, for our African strategies anyway, a passive stake into a controlling stake in a well-capitalized business in a growing market, with 60 million customers and lots of synergy between Nedbank and NCBA to be extracted. So very excited about that. On the 8 million customers in SA, that's a multi-year journey. I think the most important part behind that is our digital penetration, Ray. What do I mean by that? Our number of digitally active customers. Yep. That's grown from, let's call it in the single digits in late 2017, 2018, to almost 3/4 today. I think 3/4 of our customers are digitally active with us, which transforms the client experience, right? Transforms the sales experience, it transforms the service experience, and our clients are really giving us good feedback on our digital banking capabilities at the moment. So I think that's been, if I had to call out one thing amongst many, that would be, I think, an area that we've done well at.
Yeah. I want to go back to NCBA, though. What was the thinking behind that? Of course, you've got 60,000 or 60 million customers as a base. That is huge. But where did this come from? Where did it originate?
So, Ray, when we did our strategic refresh a year ago, we said to the market that we would do an investment review of ETI, and we learned many lessons from that, to be honest. All of those lessons have been applied in this acquisition. So firstly, I find we said, Ray, that we would be a SADC business and an East African business over time, with two major foundational elements. The Kenyan regulatory environment is very strong. In other words, we find banks there to be well regulated. You've got clarity on capital, clarity on regulations. Governance is strong and deep across that market. It's also a growing market. Ray, it's got some attributes of South Africa with stability and the like on interest rates coming down and things, but it's actually got a lot of growth, which is what we're looking for in SA. So we've got about forecasts of 7-8% growth in Kenya in the coming years. And then we kind of said we wanted to be in the top tier as we are in South Africa. So it's top 3 in most metrics, NCBA. With very strong capital levels. Right, this is a well-run business, great management team. It's also got high correlation, Ray, between earnings and cash flows. In other words, it pays dividends more or less at the same pace as earnings, which is very different to the experience we had on ETI.
It's a solid, it's certainly it's a solid decision. Jason, just going back to your digital banking, also your business banking. If you put two of them together, this has helped Nedbank, hasn't it?
Absolutely. The other thing we did early last year was reorganize and split out our business and commercial bank, Ray, as its own segment with distinctive leadership. We hired Andiswa Bato, who now leads that business from August. And we've acquired iKhokha within that, which will really help our penetration into SMEs. We've always had a really good payments or point of sale device business, Ray, in sort of mid-corporate and up. But we've never really been able to penetrate the SME segment. And iKhokha has 55,000 devices in that segment.
Sure.
We're going to get amazing data from those devices on pure cash flows, which will enable us to build both lending and investment solutions for those new clients of Nedbank. So very excited about that segment, very excited about how our leadership is evolving in that space, building on what was probably always a very good business, just a little bit hidden within a larger business.
It's bigger. And then the next 6 months, I know you guys have taken some really big decisions. They're starting to pay off. What are you looking at?
Well, look, the next 6 months, let's talk about 2026 maybe, and then beyond, because, NCBA only comes in the third quarter. Look, we're on a journey on our ROE. We won't repeat the sort of 934 million of ETI that we had in the first half last year, even if it was only accounting. It is in our books. So that's still a bit of a drag in 26, right? But from 2027 on, we would think that we should make significant progress on our ROE targets towards 17%.
Yeah.
In 2025, we're still promising to improve from this year's 15, from 15 towards 15.4, which is what we printed this year. So while we're busy transforming, we're pushing the performance in our underlying business. And, loan growth, loan momentum is picking up, right? That second half of last year was much better.
Yeah.
We took share in autos, we took share in mortgages. We've got a pipeline in CIB that I think built up nicely in 2025, which we're expecting to convert in 2026.
So in other words, Jason, it's just to start to bigger plans. We'll have to leave it there, I'm afraid. Jason, Quinn, thank you so much. Good to chat to you on this Tuesday. Thanks for joining us. That was Jason Quinn, CEO of Nedbank.